Good morning, everybody. We're on our next tech stack journey here. Today we're joined by Michael from Capitalise, who's going to walk us through their product and all the great benefits that it brings. And I'm also joined by Patrick.
Hi there, yeah, this is Patrick from the business performance team, and yeah, we're really pleased to be able to look at Capitalise in detail. It's something we use all the time. It's great to be able to access funding for our clients when they need it. So without further ado, let's hand over to Michael and he'll take us through how the product works.
Thank you, Patrick. Thank you, Rebecca, and thanks for inviting me on to this. You know, we really enjoy working with you guys, and it's going to be good to give everyone a little bit of an outline, a little bit, I suppose, deeper as to what we do, why we exist, and a few, I guess, live examples as well. So let me just bring my presentation up. Perfect. So yeah, I'm just going to go through what we call our Debt the Range presentation. It's a very quick overview of the market, why Capitalise exists and what we're addressing. And as I mentioned, a few live examples as well. Yeah, basically this is a very quick diagram showing, I suppose, the engagement between yourselves as a client, Farnell Clark as an advisor, an accountant who deals then on the Capitalise platform, which gives access to over 100 financial providers. So as you can see, there's a nice synergy between all of those three elements that provides that access point in bold there to funding. So at the moment, the Capitalise platform has about 120 lenders on it across something like 6 different types of debt funding. And those are a few of the names that you can see in there. So basically, yeah, I mean, what happens is when you go through the Capitalise funding journey, generally speaking, that will be run by the guys over at Farnell Clark, going through the funding questionnaire, making sure that they've got a general outline of the business, going to the end of the funding journey and choosing lenders. The idea being that it makes the process as smooth and easy as possible. One very simple application which connects you to up to 4 different lenders at any one time. Idea being that within a very short space of time, with minimal amount of fuss and back and forward sort of, I guess, friction between yourselves, that you can get offers and a very quick idea of the type of pricing and facility that's available to you, very much depending on whatever you're after. So that brings us to, I suppose, the why of Capitalise. Why do we need help when looking for funding? Why can't we just go and speak to our banks or go and speak to your friend down the road and get some money for your business? Well, for a while, there has been an acknowledgement that there's essentially a new era of banking. It dates back to the financial crisis, really, is where it all started, 2008, 2007, 2008, where there was a very large shock that happened across the Western banking world, and basically the central banks across kind of the European Union and UK and the US looked at the way the system was set up and thought, right, it's not quite structurally sound enough. And over time, a lot of regulation has been brought in, which has basically meant that a lot of banks have retrenched from, I suppose, the older school relationship method. Now, a lot of you listening or watching this will probably have found that actually, some of you might still have, quite good relationships with your banking relationship managers, but the majority of you will have found that access to those is at least a lot less frequent. You're not it's not as easy to go in and speak to them as it once was. 15,000 or so bank branches have closed in the last 15 years, with an estimated 55,000 bank managers having left the high street as well. And I think, to be honest, I think probably the numbers are a little bit higher now as well, with a few recent closures and redundancies announced over the last few months. So it's clear there's been a bit of a sea change that's happened, and that will, of course, directly affect the amount of exposure you have to these people who in the past would have been very close advisors to you guys. And here's a little shot, a little still from a campaign that we did. So, who are the new bank managers? How are we going to fill that sort of advisory gap that has often been there? One of our views is that your accountant, who in many different surveys is seen by businesses across the country and indeed across the world as one of your most trusted advisors. So can your accountant step into the breach? We think so. So there are a few other different things that mean that looking for funding is I suppose a little bit more difficult than you might think. The SME market is essentially constrained by cash, despite the fact that 80% of businesses are profitable. 60% of businesses don't produce regular management accounts. Even less or even more businesses hold less than £10,000 on account at any one time. 90% of SME lending at the moment is still coming from these banks. But what if they say no? What if they knock you back? There's a lot of stuff going on in the market at the moment about overdrafts. Both personal and business overdrafts are being rowed back. If you have an overdraft at the moment of, let's say £50,000, and it's only secured on, your business assets, the likelihood is that at some point over the next few months, your bank is going to ask you, can we have some security to underpin that overdraft? If you're not willing to do that, or if you want to avoid that, where do you go? The answer is a lot of people don't know. And unless you are able to turn to someone who's got a solution like Capitalise, there aren't that many other options really. And in general, the behaviours of businesses tend to work against them in a number of different ways. The key reason is that a lot of businesses either aren't accurately predicting when they're going to need money, so they're just leaving it a little bit too late. So on average, they're leaving it about 7 days or so before looking for funding, and then just not researching it enough, really. They're not spending time speaking to people that they should be speaking to, their advisors, their friends, and things like that. And most of them are just going to their bank. So 80% or so are just going to their bank. And when that doesn't go through, what do you do then? So if you're leaving it 7 days before the funding requirement, I can tell you from firsthand experience, there aren't many lenders out there that can take you from initial application to funds an account in 7 days. There's probably a handful on the market that can do that. And the brutal truth is that the ones that can do that aren't always going to be right for you. They might well be the lenders that can operate the quickest and can offer you a line of funding quickly. But is it going to be right for you? Is it going to be the type of funding that's right for you? I think if you were to give yourself, a minimum of sort of 2 weeks, 2-3 weeks, in order to, up your time researching and speaking to your advisors, the likelihood of you getting funding in place that is going to be much closer to what you actually need is a lot higher. Okay, here is a very quick little, I suppose, illustration of what the market, the lending market, the business finance lending market, should I say, in the UK looks like. So by some estimates, there's over 360 lenders in the UK alone. Obviously, that number kind of fluctuates as you go by. But as you'll see, there's a lot of different names, a lot of names you won't know. And the number of different lenders has basically exploded since the financial crisis that I mentioned to you earlier. So the outer ring is basically, I suppose, the start of the fintech boom that we saw. The inner ring is just in the immediate years after the financial crisis, and then 2001 and below, you'll see a more a bigger range of household names that you would have perhaps heard of. From Lloyds Bank to Close Brothers and things like that. But for example, have you ever heard of the likes of Lending Crowd or Just Cash Flow, people that are lending quite a lot of money at the moment to small businesses? So you'll see it's very much a paradox of choice. If you start at the bottom ring, you speak to your bank, who could be Lloyds, and Lloyds say no. How are you going to navigate this, very, very crowded market? That's where we come in. That's how we provide the access points, and then we look to work with firms such as Farnell Clark to make that process easy.
Cool. I have a question for you, Michael.
Sure.
How does Capitalise screen, say, someone approaches yourselves to go, right, okay, I want to be, say, on your lending platform? Because like you said, there's a lot of names there that you aren't sort of day-to-day names. What sort of screening processes do you go, say, for their interest rates? How do you sort of monitor that?
Yep. So we basically, it happens weekly almost. So if you think at the moment we've got about 120 lenders on the platform, what we try and do in the first instance is we're trying to make sure that we've got every single type of credit on the range covered. So for example, if you're looking at a business and directors who've got A+ credit, who are looking for very keen pricing on commercial mortgages, overdrafts, that sort of thing, we need to make sure that we've got a very strong coverage there. So of course we've got the high street banks that are on there. We've got Lloyds Bank, Santander, NatWest, all the usual suspects. And then, all the way down to the other end of the spectrum, where you're looking at a bit more sort of business rescue funding or restructuring and turnaround situations. Now, obviously there are probably less lenders that play in that space. And, pricing tends to be a little bit higher, but it's obviously for the solution that we're providing, we need to make sure that we've got a really strong, a strong range of different lenders across that whole spectrum. And what we do, of course, as we refer, inquiries to them, we make sure that, the lenders are doing their job. Basically, they're providing a strong service. Their aftercare is good. Obviously, we're targeting them on all of these things. And, if we've got a lending partner that the relationship isn't quite working, it's not quite there, we'll either take them off the panel or we'll put it on hold. And the same thing is, if we come across a lender that's new to market and they've got a really interesting solution, we'll meet with them. We'll try and assess whether we feel that their products will have, will fit in a gap on the platform, as you say. And we'll trial them out and we'll see if it works. And if we get a positive response from our accounting partners, if we get a positive response from the businesses that use it, then that's a good reason to continue using them. And we're constantly looking to refine the lenders that we have, and I think we're pretty confident that we have some of the best lenders on the market, and we're always on the lookout for making that better as well. So yeah, when looking at the range of different funding, different facilities, I suppose, that are out there, it's important to look initially at the different reasons that you might look for funding. So kind of, what we like to call it and visualize it internally here is purpose, product, provider. So the first P is purpose. Why are you looking for funding? Are you looking for funding so that you can sort out succession planning for your business? Are you looking to sell? Are you looking to sell to your management team? Are you looking to sell to a family member, or is someone looking to buy it from abroad, etc.? Okay, that's just a quick overview of the different types, and then we have a very nice little diagram showing the different types of solutions. So I think we've got 6 different solutions on there, covering the entire debt funding lending spectrum. So many of you will be familiar with Invoice Finance. It's a pretty common one offered by all of the banks. If you have a relatively large debtor book and you've been trading for a while, the majority of banks will look to help you with that one. Working capital finance pretty much covers the whole spectrum. So term loans, short-term facilities, overdrafts, line of credits, that sort of thing. Trade finance is related to invoice finance. It tends to be for businesses that are operating in the sort of import and export space. Property finance, which if any of you are either property developers or do a bit of property development, or sort of I guess have a portfolio of buy-to-lets on the side, you'll be very au fait with that. But also, if you're looking to exercise a purchase option on the office that you're in, that's something that's quite interesting.
A question about security.
Yeah.
Is it usual that business owners would have to put up their own property as security? Is that something that happens often?
So it depends really what type of lenders that you're looking at. So I would say, as mentioned, a lot of the banks are either retrenching overdrafts or asking owners to put security down to help keep those in place if they weren't already secured. So I think increasingly lenders want to ensure that their facilities are secured, and the most common and readily available security is equity in a director's home. However, there are a lot of facilities out there on the market, especially in the alternative space, which can just be backed by personal guarantees, can be backed by a debenture over the business assets. So I would say increasingly lenders are likely to ask for it, but there are options where you can sort of, I guess, stay away from it if you prefer to. So across those 360 different lenders, a lot of them will have their own ways of looking at it and their own sort of acceptability from security requirements. But to give you I suppose, an overview of the types of funding that we tend to see at Capitalise, the majority of it is personal guarantees only. So the directors will sign a joint and several personal guarantee, and you'll be looking at a 12 to 60 month term loan. But very much it depends on what the facility is. It's a difficult question to answer succinctly. But there are other facilities as well. So, as I mentioned, asset finance. When you look at asset finance, the asset itself tends to be the security that the lender needs there. So they'll ask for you to put kind of 20% of the facility, which covers the VAT, and the asset itself tends to be the security for the lenders there. And with merchant cash advance, the maximum that lenders will ask for there is a personal guarantee. Some lenders below a certain level don't even ask for security there either. So just a quick one on merchant cash advance. It's one that a lot of people probably haven't really heard of. If you're a retail business, or potentially if you take payments online through Stripe and things like that, there are lenders that will look at the revenue that comes through your terminal. They'll take a 12-month average slice of revenue from that, and they'll give you something like 100% to 150% of your average monthly takings as a loan through that card terminal. And what happens then is they'll set up what's called a split, whereby the lender will take a percentage of each card payment that comes through that terminal. So it could be something like 10p in a pound, that sort of thing. So it's a very interesting solution, I would say, for retail businesses, especially retail businesses that have seasonality. And if you're having a month that isn't quite so busy, if you're looking at servicing loan costs that are the same every month, it might not be as easy to service in the month of January as it is in the month of July. So something like that could be quite useful. Okay, and here's some funding in numbers to kind of bring it to life a little bit. So as you'll see on the top there, we've got 25k up to 10 million plus, to give you a sense of, I suppose, what you're likely to see through the Capitalise platform at those levels of funding. Anything from kind of, let's say, 10,000 up to 350, potentially 500,000. You're looking at revolving credit and unsecured business loans, alongside the merchant cash advance facilities that I spoke to just then. Secured business loans tend to start at around about, let's say 50 to 80,000, and can go up to however much the lender would say that serviceability is evidence, and also the value of the asset as well. And invoice finance and asset finance also similarly can go up to a very large amount, and those multi-million pound facilities tend to be for businesses that have got a variety of different assets, very large debtor books, large contracts, and things like that that lenders can look at and really get their teeth into. Okay, so that brings me to a few different case studies I wanted to have a chat with you about. Very much the funding in action. These are all situations that I've personally helped out in, and they've all come through accountants who've referred them onto the Capitalise platform. So their advisors, the client would have gone to their advisor and said, look, I have a problem or a situation that I need funding for. What can we do? Their advisor had come to us, or me specifically, and we'd help them out with. So the first one being working capital finance and term loans. So as you'll see on the left-hand side of your screen, there's a number of different things that you can look at for working capital finance and term loans. Essentially, I would say it's probably the most wide-ranging of products out there. They tend to be backed by just personal guarantees. However, in certain situations, quite rare, but you can potentially look at no PG lending in that space if your business is doing very, very well and you've got very good credit. And also some of them may need to be, to some extent, backed by, charges on property, whether commercial or residential. In this particular instance, we were looking at the refinancing of a short-term high-interest loan. So their advisor came to me and said, look, the client's got a few loan facilities. They're short-term high-interest. They were short-term fixes, basically. They had a bit of an issue in the month previous, and essentially went online, went to the first solution that they could find. If you cast your mind back to the bad behaviors that I mentioned earlier, they left it a little bit too late to look into it. They essentially took what they could get, and it was a quick fix. But what they found as they were moving through is that the repayments were really eating into their cash flow and their profit margins. So when they came to their accountant introduced them to us, and we looked through their financials, had a chat with them, and said, basically, it looks as though you've got a healthy enough profit margin. And by the sounds of it, you had a good enough credit for us to go in there and look at changing what you've got. So when we did that, we were able to reduce the APR and the lending that they had by 50%. I think it was slightly over 50%. We increased their repayment profile to 60 months from 12. We included the ability to make overpayments and early repayments on the loan, and also achieved an uplift in funding to allow for further working capital as well. So we didn't just get them cheaper funding, we got them more funding, and really improved their cash flow position as a result. So it was a win on 3 different counts. But you could look at that and say, right, perhaps something like Invoice Finance might work for me moving forward, because it's going to enable me to essentially get the money in and out quicker. It'll enable me to pay my suppliers quicker, get the money for my debtors in quicker. It'll enable me to take on more projects. It'll enable me to ensure that I know I've got enough money to pay payroll, and I've got enough money in accounts to, if any shocks come up. So that's one of those really interesting ones where you're looking at more of a strategic level, and you're saying, how can I avoid the mistakes that I made last year, and how can I turn that into an advantage moving forward? So some businesses, for example, if you're a construction business is one example that I'll talk about now, but if you're a temporary recruitment business, and you've got temps that are going in various places, raising timesheets and expecting to be paid weekly, but you're not being paid for 90 days by let's say the NHS, unless you've got a lot of money that you're starting off with as a float, how are you going to be able to sort that cash flow cycle out, whilst also not just paying people and getting paid, but also focusing on your day-to-day business and growing your business? Sometimes a facility like Invoice Finance is just a cost of doing business and a cost of growing your business. And I think that's a way of yeah,
it shouldn't be seen as something necessarily shameful to have to go for. It's just a part of growth. Invoice finance itself is often misunderstood. Could you take us through what can and cannot be financed, what invoices can and can't?
Yes. So I guess temporary recruitment is quite an interesting example. All invoice finance lenders, I would say without fail, will fund temporary recruitment, because it's a very easy timesheet. I've done 7 days this week. These are the hours that I worked. It gets signed off by whoever they were in, and you can then raise an invoice based on their daily rate or their hourly rate or whatever it was. And lenders will give 90% of the value of that invoice, and it will be grand. However, a lot of businesses don't have the luxury of it being that straightforward. So, for example, construction projects can take a very long time, as we know. They can, have overruns. There can be discrepancies. There can be applications for payments for subcontractors from the main contractor that they're working with, or whoever they're working with up the chain. There are retentions involved, just in case there are any sort of disputes at the end of the project, that kind of thing. But in general, the whole sort of view of invoice finance is that as long as the debt can be verified by the end client, and the likelihood of it being paid back, is either 100% certain or very certain you'll get the majority of it, a lender is likely to advance that as long as they're happy with the work that's been done. Okay.
I've found problems in the past if people invoice ahead of time, so maybe for 3 months worth of service. That won't be accepted because it's invoicing ahead of time.
Yeah, so pro forma invoices aren't accepted because, so for example, if you're raising an invoice and someone says, yeah, that's fine, there's a lot of different areas where that can fall over. You can get disputes. Basically the likelihood of the lender getting the money back that they've advanced on that is, you know, umpteen times higher.
It's reduced, yeah.
Yeah.
And what about your existing debtor book? When something goes beyond its due date, that's also a no-no, isn't it?
It depends. So, you know, when you look at an aged debtor book, you'll have kind of 0 to 30 days, 30 to 60, 90 plus. Most invoice finance lenders will fund an invoice up to a maximum of 120 days. Basically, the calculation being that after 120 days, the chances of a business collecting that debt that's owed to them is very small. Most of them will end up having to write that off, which means that if a lender has funded that invoice, the likelihood of them having to write that off as a bad debt or have recourse back to the client for the amount owed on that invoice is a lot higher. So anything within that range, in theory, could be funded. But generally speaking, between 90 and 120 days, you're sort of in the red zone. Right. So pro forma invoices and really late invoices are kind of a no-no.
And lastly, we just want to say that the actual information required by the business, I mean, this is the process we manage to take them through the platform, input what you guys call their profile to build up the information. It is relatively painless. It's mostly just recent financials and that kind of thing. Have you got anything else to add there, Michael?
No, so basically, I would say for the majority of funding searches that you'll go through, except if you're like a property developer or something like that, lenders will require up-to-date financials. So, you know, if you look at your latest full accounts, up-to-date management accounts, 6 months bank statements, 4 quarters VAT returns, updated, you know, address history, date of birth, so that lenders can do their credit checks. And then, you know, if you're looking at certain different types of funding, so for invoice finance, you'd want an up-to-date debtor book. For asset finance, you'd want a quote from the supplier of the asset, for example, so they can go in and do their desktop valuations of it. But generally speaking, you're looking at as up-to-date financials as you can gather for those main sort of 4 or 5 different areas of the business. And that will enable them to do their serviceability calculations. That will enable them to essentially make sure that they can provide a pricing or at least a price kind of banding to the client.
Okay. Well, should we wrap it up there? We've slightly overrun, but it's such an important area, and I wanted to get a bit more detail on.
Do you want me to so they obviously there's a number of different funding.
There's the various
things that I can go through here. So asset finance, invoice finance, and property finance.
Yeah, you've got some big numbers there.
Legit, yeah.
Quite often we're not going for $1 million on with our clients.
Yeah, exactly. But no. I mean, I guess the gist being is that I wanted to sort of go over situations that were slightly atypical, but also talk about some of the typical situations. So, you know, if you're looking for asset finance to buy a new van, great, you know, it's quite straightforward, but you can also use asset finance to, you know, execute a management buyout or an acquisition, for example. Now, I thought I'd go through some quick FAQs. You wanted to, so, you know, essentially some main questions. So, you know, is my data safe with Capitalise? Yes, essentially the platform is GDPR compliant. You know, how long will my application take? You know, the answer is it does depend, but some applications can be approved and completed in less than 24 hours. Others can take weeks to, you know, a couple of months to conclude. It very much depends on who the lender is and what type of product that you're after. The levels of funding that you can get, you know, there's a few rules of thumb that you can look at, but essentially, you know, if you're looking at short-term funding, look at your turnover and take, you know, like an average monthly turnover. That will generally be the short-term lending that you can get over 12 months. The net profit number, if you're looking at sort of term loan lending and you've been trading for a few years, if you look at your net profit and you take 3 to 5 times that, you can look at a term loan against that. And then if you're looking to buy an asset, obviously the value of that, less sort of 75% net amount of that asset is generally what you can get. And then we touched on the home security question earlier on. Rates, they can vary pretty wildly as well, depending on credit and how long you've been trading, etc., etc. Anything from between 2% to 40% APR is potential. Obviously we hope it's further to the left of that range, but you just got to be realistic that sometimes it's further to the right. And when should my accountant be suggesting Capitalise? Basically, whenever you're looking to grow your business, purchase something new, plug a cash flow gap, refinance something, essentially look at achieving a goal that you can't or don't want to fund out of the money that's sitting in your account.
Cool. Well, thank you for your time today, Michael. It's all been very helpful and gives us better insights into Capitalise and their world of lending.
Mm-hmm. No, thank you very much, guys. Thanks for your time. And what I'd say to anyone listening to this or watching this, if you are thinking about something in the near future or you want to plan for something, definitely get in touch with Farnell Clark, and they'll kind of be able to walk you through the next steps.
Cool. Lovely.
All right. Thanks very much.
All right. Cheers, guys. Bye.